Hi everyone, this is Rob Roy, and welcome to the LA Wave Elite U.S. Market Update. A little bit of economic news to discuss before we get started. On Wednesday, the Federal Reserve met. They decided not to change rates, which that was pretty much expected, but they went a little bit further. They actually came out and said that they're not going to raise rates for the rest of the year. Now, we went into this year with the expectation that there would be 3 rate hikes in 2019, and there hasn't been any, as I'm sure you're aware, and now they've said that there aren't going to be any either, which the Federal Reserve just never does that. They never come out and actually telegraph policy basically for the next 9 months. It's just unheard of, and the market is kind of gyrating back and forth here trying to figure out how to handle it. But one thing that's concerning the market is the yield curve inverted, the big one this time, which is the 3 month versus the 10 year. We talked in the past about when the 2 and the 5 inverted, the 2 year and the 5 year, but a lot of people dismiss that, even though an inverted yield curve has forecast every single recession for the past 60 years, and there's already articles throughout the weekend saying that, oh, well, it's different this time, and it doesn't necessarily mean a recession, even though it's telegraphed one every time for 60 years. But those that were dismissing it in the past were saying, well, the 3 and the 10 year, the 3 month and the 10 year didn't invert, and so it's not as meaningful. Well, now they have, and that occurred on Friday, so you can see in the right-hand corner here where the two had crossed. And remember that you're supposed to earn more money when you commit to holding a security longer, in this case a 10-year treasury. So when you're going to get the same amount of interest to hold something 3 months as you are for holding it 10 years, it doesn't make a lot of sense, and that's what concerns people. And again, it's forecast all the recessions for the last 60 years. Down at the bottom here, this is the difference between the spread, and you can see it's basically crossed that zero line. That's the zero line in the bottom left. So taking a look again at the markets, here we had Wednesday's bar where we were kind of sideways. Market didn't know how to react. The next day we moved to the upside on Thursday, and then we gave it all right back on Friday, plus some because of the inversion of the yield curve. So a lot of people thought we were headed up, myself included, to move up, and we still may very well be, and I wouldn't be surprised, and I actually expect that we will come up and hit that. Last week we talked about the fact that you don't know when. Could we pull back before we go up there? But it's the completion of the Elliott wave retracement pattern to go back up to those previous highs, as we talked about last week. So I still expect that to happen, but with Friday's move, we may get a bigger pull down. Now, we also had the release of the Mueller report, which a lot of politicians had been waiting for, and the concern that there may be something that would allow President Trump to be indicted or to be impeached. And it looks like there's nothing too damning in the report, and that issue may go away. The futures are up right now, and we'll see how that translates into tomorrow's trade. Looking at the SPY for volume, we had a pretty big volume day on Friday. Not incredible volume, but above average volume, which you would expect on a downward day. And looking at the VIX, last week we talked about, well, we may be heading back down towards support here, and we didn't quite make it all the way down to the 12 level for support, but on the 19th we did make it down to 1237, so that's pretty darn close. And then we had the move up that occurred on Friday, and we'll see how long this volatility lasts. It may back off quite a bit on Monday if the futures hold and the market opens to the upside, but then there's the entire trading day to go. Now here's something interesting. Looking at TBT with the Elliott wave count on, we've talked about this. We had the wave 4 retraced 38%, and then we had the flat that went through here that we talked about last week. So we had a complex wave 3, right, and then the wave 4 there, and we come down and we're almost to the wave 5 target. And look, ever since the Federal Reserve meeting on Wednesday, boom, 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 3 big down days on rates, and you would expect that to occur with the Federal Reserve saying they're not going to raise anything, and that's what helped to cause the yield curve inversion. But just spot on with the Elliott wave pattern moving down to that wave 5 lows. It's kind of a little bit difficult to believe that rates were going to go that low, but the Elliott wave pattern forecast it, and that's exactly what happened. Looking at the dollar, we're in a series of the corrective ABC sideways patterns, and it looks like we're in a bit of a trading range here, which ties in with the ABCs of the corrective patterns with flats. We have the resistance up there around 97.5 or so, and then support down here in the 95 range. We came down into this area that occurred on the 20th of March, and we're just kind of moving back and forth. We've got this gap to get filled, and then of course we still have all of the drama that's going on with Brexit, and that's going to affect the dollar with the news going back and forth there. With interest rates going down, you would expect the gold to move to the upside, and that's what's happening. We've got a really nice Elliott wave pattern to the upside here, a 5-wave directional pattern. The wave 4 corrected right at the 40%, very similar to that 38% corrective level that occurred on TBT, and so I really like the 38% level. Fibonacci is a very strong level. It's one of the favorite levels that we look for. So then we've got an upward target of gold all the way up into the 130 area or so. It's got some time to get there, but we're on a 45-degree march, and when things move 45 degrees like that, we tend not to get too far overbought, or we don't get too far oversold on a corrective move. It tends to be one of those that just kind of marches to the upside. And with the green light now from the Federal Reserve, the rates are going to stay down, and the dollar, once it's left to its own device after the Brexit thing is settled, then it's likely going to back off a bit as well, and then we really could see the continued move higher in gold. Looking at the bigger pattern, the monthly pattern, we still, we only get a couple bars because it's monthly, and we broke out of the upward trend line, and we're coming back down to test that now. Exciting thing happened last week with AutoZone. We talked about this one. Again, spot on with the Elliott wave pattern. We had our butterfly with 980 in the middle, and that is exactly where we went. Like, we actually closed right at 980 on the 20th of March, and then in the next couple days we moved to the upside, hit the top part of the range here, and then closed right back down again at 980. That was a 100-point move on that wave 5 that we set with an out-of-the-money butterfly, which obviously works out extremely well, and that's one of the neat things that we like to do, is that the out-of-the-money butterflies are so inexpensive, and if you get the direction even somewhat right, it doesn't have to come hit the midpoint like this. That's just the gravy on top, but just a directional move can be extremely profitable. We had to look at this congestion that we had here, the resistance of the lower line. It's amazing. And I've said this a bunch of times, but if you have Profit Source or Elliott Wave and you haven't renewed your data feed, why not? Look at what we're showing here, and if you haven't, then you need to do so. Go get it. Another butterfly that we have is MPWR, which is moving to the upside here as well, and we have our midpoint of our butterfly at 150, if you remember, with that being a march to the previous highs. But look what's happened with the recent move is that we have relabeled now, taking out that 1 into a wave 3, and so it looks like we should have no problem at all getting up to that 150 level, and again striking the midpoint of our out-of-the-money call butterfly. Last but not least, with Starbucks. Starbucks continues to march to the upside. We set our target at 74, looking for just a little bit more of an extension here out of this wave 5, so that's the targeted price for Starbucks, so that one's moving well. So all of our case studies look to be performing extremely well. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.